flowing?
Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report. And boy, do we have a silver report for you today because something crazy is going on in SLV, in the gold and silver markets. There's a lot of bullion that continues to flow.
Is it flowing?
From London or its proxies into New York. The flow has not stopped, and it looks like there is some kind of supply shortage, especially in the silver bullion market. We can see that from the borrowing rates for SLV particularly. GLD is also spiking, which means that there are a lot of shares being borrowed, which in any normal time would mean that people are shorting these funds. But in these times when silver and gold bullion are in serious demand, they're probably borrowing these funds in order to redeem baskets to fulfill the demand for bullion. And now they are short these ETFs and they cannot cover yet. We're going to go into this slide by slide. And we're going to go into the difference between 2020 and now in 2020 from about April to July, August. There was a huge inflow of gold and silver bullion into the comex.
Flowing. I like flowing, cascading.
At that time, the ETF holdings were enlarging. That's not a word.
And biggins? Never heard that word.
I don't know why. It's a perfectly cromulent word.
We're growing. But now they are shrinking because the demand is not in the ETFs. It is in the big players, in the banks, in the financial centers. So let's quickly go to the slides today. And this silver report is brought to you by, first of all, my Substack. Check it out at endgameinvestor.substack.com. The link in the description below, where I write about this phenomenon, which could be called Silver Squeeze 3. Also brought to you by Miles Franklin. Get your gold and silver with them. Link in the description below and mention the Endgame Investor. And if you want to hear what I think about Trump's Gaza plan, then sign up for the Patreon, where I go into other topics, including the relationship between money, government, and God. But anyway, let's get to these important slides. These charts are from Bob Coleman. Follow him on Twitter. He knows a lot more about the intricacies of the COMEX than I do. I can give a good overview, but he knows the mechanics of it. So the GLD borrowing fee spike hat tip, Bob Coleman. The borrowing fee on GLD, that's the gold ETF that has the most gold in it of any ETF. So we'll use it as a proxy for the entire ETF market. The borrowing fee has gone up to 4.7%. You can see here. From 2.4% back 2 days ago or 3 days ago, depending on when you're watching this. February 5th, it was 2.4%. Now it's 4.7%. This is the daily chart of the GLD borrowing fee. You can see here there was a huge spike. The available amount of shares of GLD for borrowing was 1.3 million 2 days ago, and now it is 1.1 billion. So there's still 1.1 million, excuse me. So there's still a fair amount of shares, and it hasn't really shrunk that much. So do I think that there is a squeeze in GLD? Not quite yet. We'll go to the next slide in a second. But the point here is, why would people be borrowing GLD? They'd be borrowing it so that they can redeem those shares for bullion. How GLD works is you redeem a certain amount of shares for bullion in a basket, and then you can take that bullion and do what you want with it. But if they don't own those shares and they redeem them, and those shares no longer exist, and they have to buy them back from somebody else, or put the gold back, so they are short gold now in order to fulfill some kind of a delivery, something. Nobody knows exactly what. But we go to the next slide here. We see what is going on. I don't think there's quite a squeeze in gold just yet, but wait until we get to silver. This is Ronan Manley. Follow him on Twitter. Bullion banks are borrowing GLD shares and converting the units to physical and gaining control over that metal, i.e. rating the SPDR Gold Trust. So I looked at the GCRU, the Gold Charts Are Us charts here of the GLD ETF, and you can see here on the top, gold is going up. It's now at $263 a share, and that's an all-time high. I think it was the high was the all-time high was 265, so we're right there. And the total metal in the trust, it has not gone much. It hasn't gone down. It hasn't gone up. It's stayed pretty steady since January, slightly down from whatever this is. I can't really see. Was that 870 tons to now 864? So about 10 tons. It's been down a little bit, but this doesn't look like a squeeze just yet. The thing is that and I'll show you this in the following charts, that the holdings in the GLD are not going up. So it could be that the demand for GLD is being canceled out by the demand for the gold in the GLD in order to fulfill delivery requests. Here you can see the movement of the price in GLD and the amount of gold in the fund, it doesn't look like it's being slammed down so much. So my gut says maybe on this.
All I know is my gut says maybe.
But if we move to SLV, we can see there is a major difference this time. I show you here the 2020 delivery rush. Remember, there were huge amounts of deliveries in 2020, especially for silver and gold. There were all-time records back then. You could see here the black line and the blue line were going in tandem. So the blue line is the price of SLV shares. The price of silver was going up, and you can see the black line, the amount of silver in the ETF was going up and up and up and up. So the demand was to put silver in that ETF at that time. That's what the deliveries were going for. A lot of them, at least not all of them, but a lot of them were. Now it's the opposite. Now the price is going up and up and up, and the amount of silver in SLV is going down and down and down, almost in a mirror image. So as the price goes up, people are shorting this ETF. We'll see those numbers in a second. And they're taking this silver and they're using it for deliveries. Exactly what to who, we don't know. So if we zoom in on this, we can see that the amount of holdings have gone down about 1,100 tons in 3 weeks as the price has meandered, and it's nearing $30 for SLV right now. So yeah, this does look like a run on SLV. And Ronan Manley also notes, and Bob Coleman too, that the borrowing rate on SLV has skyrocketed a lot higher than GLD. So I think the squeeze right now is in SLV and in silver, less so in gold, but gold could catch up, and it might be doing that right now. What happens if these funds are being rated? If SLV and GLD are actually being rated, then here are the logical points. If they're borrowing shares, if big financial centers are borrowing shares of GLD to SLV to redeem baskets and get that gold and silver out to satisfy physical demand, then they will have to buy those shares back at some point to cover. Third point, if gold and silver continue to rise when they are short that gold because they've already sold it to somebody and they're short the shares, and they are short shares because they needed them to redeem baskets, they will get squeezed. This could very quickly trigger a dollar collapse. Will it necessarily? No, but this is one of the mechanisms that could cause a serious bash or a serious drop in the dollar and all of its purchasing power. Eventually, it's going to happen. Whether these ETFs are going to be the trigger of it, I don't know, but they are one potential. Ronan Manley says, this is a direct quote of his tweet in 4 bullet points. This was retweeted by Greg Hemke, so I'll put a link to the tweet in the description below for those who want to see it directly. Ronan Manley says, the gold clearing banks of London Precious Metals Clearing Ltd have exhausted the metal that they have available for delivery in their own vaults. So they are trying to borrow as much gold as possible via the gold lending market at the Bank of England. This is why the delivery times at the Bank of England are being extended to several months because they're running out. But this looks exhausted too. These clearing banks, JP Morgan, HSBC, UBS, and ICBC Standard, need to keep gold in their vaults for their own local London liquidity. But it looks like they don't have any more gold to do this. Counterparty risk has therefore risen between all the LBMA bullion banks, which trade unallocated gold credit between each other. The clearers, the market makers, and all the other LBMA bullion banks and brokers and traders, about 50 plus entities. Basically, they trade paper claims on gold or the electronic equivalent. Now, the key here is in the bold. These claims are now trading at a discount to reflect the fact that they can't be converted at will into physical due to a lack of availability of sufficient local London physical gold. And so the claims on gold are starting to trade at a discount to physical gold. As the demand for physical gold rises, the demand for electronic gold falls, and you have a spread here. And so that spread could be encouraging people to sell short SLV, where you can get silver cheaper and deliver it for a premium because people want physical now. There's starting to be a loss of faith in the system. It's manifesting as a premium for physical over electronic or paper. Now, in the gold market, we can see here, we have open interest versus the price. The price keeps going up and up and up, and open interest keeps going down from a peak of 600,000 to now about 535,000. These numbers are 1 day out of date. Why is this happening? It's not exactly a short squeeze. What is happening is that open interest is closing because of deliveries being made. Once the delivery is made, the contract closes, open interest falls. And because these deliveries are not and because open interest is not falling through the sale of a position, then the price doesn't get affected by the open interest falling. It just keeps rising and rising. Open interest is resetting itself downward, which will give us the fuel for another leg up at some point. If we're still already in it, we might already be in it now. I don't know. Now, for the delivery picture, here's where we are. We're on pace for 60,847 warrant deliveries from London to New York primarily. We can see here the total is 52,577, and the remaining open interest is 10,382 contracts for the February contracts still open. If we subtract 2,112 from that, because this is 1 day behind and this is current, then we have a total of 60,847 warrant deliveries. That would be an all-time record. The all-time record is 55,102, if I am not mistaken. So here we can see the deliveries, and everything before 2020 is much, much lower than these numbers, so there's no reason to stretch out the graph that far. This is the all-time record over here in June 2020. We can see here that we're already at 52,577, and we're going to breach the all-time high in the next 2 or 3 days as these contracts continue to be delivered. A lot of that gold is headed into the COMEX, which is nearing the all-time highs for physical supplies that we saw in 2020. We're not quite there yet. We're about 6 million or so ounces below the all-time high. And now if we go back again and look at the difference between 2020 and now, the 2020 delivery rush, that was over here from about April, May to about July, August 2020. Where was that physical going? It was going into the ETF. You can see the black line here for the total GLD amount of gold in the fund. It went from about 900 tons to 1,270 tons, something like that, in the space of that price increase. Now the price increase is not affecting the ETF because the gold is being redeemed in order to satisfy more physical demand. So basically, you could say it like this. In 2020, the demand for gold was in the paper market. Now it is in the physical because the paper market is not stuffing any more gold into its funds. The demand is going elsewhere for big actors that want the big bars and they don't want shares of GLD. You can see the same thing in silver also between 2020 and now. The ETF is going down. Back then, it was going up in terms of the holdings. I'm not talking about the rest, I'm talking about the holdings. The holdings were going up. Now the holdings are going down as the price goes up. So basically, what I'm saying is that the demand, these delivery demands, are not going into the GLD or SLV ETFs. They're not going into the paper market. This reflects what Ronan Manley has been saying, that the demand premium is in the physical and the rest are trading at a discount because not all of the paper claims can be fulfilled with physical bullion anymore. Is this going to calm down? Is it going to cause a huge silver squeeze or gold squeeze? I don't know, but one day, very soon, it's going to happen. I would encourage all of you to check out the Endgame Investor on Substack, where I go into the reverse repo situation and the plumbing, as I usually do there. That is really my expertise. Ronan Manley's expertise and Bob Coleman's expertise is what's going on here, so I thank them for their tweets that I used in this presentation for this week's Silver Report. For the Endgame Investor, I'll see you guys pretty soon, because things are ramping up fast.
Where are we? It looks like we're in the teens somewhere.
But when we get to 20, tell me. I'm gonna throw up.